Imperial Holdings has posted a steady set of full-year numbers, while revenue and operating profit increased 8% and 3% respectively, leveraging off the full-year inclusion of the Imres and S&B Commercials acquisitions. Headline earnings per share decreased 3%, but it's Imperial's grim outlook that's got the market's attention today. Earlier, I asked its CEO, Mark Lamberti, what their biggest headwinds are right now.
I think the biggest issue for caution in our guidance is currency. Currency has a big impact on our business as an importer of vehicles, but also our offshore earnings are subject to currency movements, and even something as such as the Brexit weakening of the pound. The numbers that we budgeted just a few months ago are now substantially less on translation. So currency movements is what's given reason for caution. I thought we were brave to go a year out with some guidance, but the main caution is around currency.
Of course, you've got rand strength having filtered through in the second half of the year. So talk us through, the extent to which you've seen that impact your operation so far.
Well, the rand strength, of course, is interesting because we have an ability to put up prices in our motor vehicles, but at the same time, we have hedged the rand. And so we sit here today with our with the rand hedged out to about April next year at something close to 15 rand to the dollar. That's much higher than spot right now. So effectively, we have inventory that's higher priced and possibly competitors that are not going to put up prices as rapidly as they would have had the rand been weaker. So it's very much at the trading level that it affects us like that.
Yeah. Talk us through the demand scenario right now, specifically within the vehicle division, because that includes importing, as you highlighted, dealerships, rental operations in sub-Saharan Africa, and, this within a scenario where we're looking at private consumption expenditure in distress, rising interest rates and tightening credit sales as well.
Yes. Norms are predicting something around 560,000 new vehicles this year. We think it might be a little less. The fortunate part for us is that the global manufacturing capacity far exceeds demand, as I'm sure you're aware. And so our manufacturers in Korea and in France are not that uncomfortable with watching absolute numbers decline, but they get very concerned about market shares declining. And therefore, they have been assisting us. And so that's one of the major reasons that you can see an improvement in our import business despite a softer rand.
Having said that, Mark, you do have exposure to pre-owned vehicles as well.
Yes.
So are you seeing some of what you're losing out on the new vehicle sales side of things being picked up on the former?
The ratios of new to pre-owned always rises in times like this, and that is the case right now.
Okay, so that offering some cushion. Let's take a look at, the extent to which your divisions have contributed to the business, because you've had strong performances from the vehicles division, but also logistics in rest of Africa. That's a division contributing positively to your operating profit as well. So talk us through that, because already you've made your target where you've got revenue there beating that of revenue generated within South Africa.
And profits.
Yeah.
Yes. So that was a little bit by default because our South African business did not do that well. But we're extremely proud of what we've achieved in Africa. We built a business approaching 12 billion rand in revenues in Africa in just 5 years. The profits are heading towards 900 million rand. And we think that our success there is because we've very, very carefully chosen the sectors. We are in pharmaceutical distribution and FMCG distribution. And the way we've gone about making the acquisitions, we think, has been prudent. So we're very comfortable with our growth in Africa. We're on target with all of our acquisitions. They're either in line or exceeding expectations.
Is that then what's steering your logistics operations focus on the international arena? Because for logistics, volume growth is what you're after. And in a waning economic environment, defensive categories, I guess, is the sensible route to take.
Yes, I think that's partially true, but I would say the overriding drive in just about everything that we're doing in Imperial at the moment is to make the group a less capital-intensive business. And so those businesses are less capital-intensive. Our biggest, I think it's our second biggest acquisition in our history, which was the acquisition of Palletways, was another very, very capital-light business. and that moves us away from the capital intensity that our logistics business was.
Yeah, let's hone in on that strategy, because you're focused on releasing capital, sharpening your executive focus by disposing of non-core and strategically misaligned operations, your underperforming assets as well. How much more whittling away do you have to do here?
We're close to the end. We've sold about 5.2 billion rands of assets. One or two of them are still subject to regulatory approval. But if those go through, the only disposals we need to do is of what we have classified as non-strategic property, where we will either sell them or sell them and lease them back. And that's the bulk of it. I think the business will then move into a normal mode of selling underperforming assets at the divisional level as and when that happens. So I think we're largely through what one would call the restructuring of the portfolio.
You say normal business growth. How much of that is planned to be acquisitive down the line?
I would hope a lot of it. We are clearly focused on our logistics business in total, that is in Africa and in Europe, becoming a much, much bigger part of the group. It's about just over 40% at the moment. And we will have to do substantial acquisitions for that to happen. The pipeline is reasonable. We have to be careful.
That was Imperial CEO Mark Lamberti. After the